be talking today about the ratio analysis. So you may off your video for the time being so that we can discuss these in detail. You may off your videos. So thank you so much. So today's topic of discussion will be ratio analysis. As in the paper of accounting for managers, we are discussing the financial analysis or preparing the interpretation base for interpreting the financial statements. So we have discussed till now common size statement, comparative income statement, comparative balance sheet. We have discussed trend analysis. So all these were the part of the discussion. Similarly, we followed the statement of cash flows, which is a part of the financial statements now. So basically, we here wish to discuss now what are the other tools which are available. And one of the very important tool is ratio analysis. So ratio analysis we are using from the various centuries. People, whenever the accounting system starts, we are relating the one figure of a financial statement with another figure of financial statement. The basic purpose is so that we can have arrive at a conclusion whether some kind of technical analysis is needed or what are the various kind of results which the financial statements are showing, because financial statements in itself do not show any results. They just give you the figures. For example, you have the net profit or loss in the income statement, or you have the assets in the financial statement, that is balance sheet. But unless and until you compare the figures of one financial statement with another financial statement, or you compare some kind of figures with industry comparison, you cannot arrive at a particular point of time results. You cannot get good results, or you cannot interpret the financial statements in a good way. So that's way, as a part of financial statement, we started with the common size statement, then comparative statement, then income trend analysis we undertake. So statement of cash flow was prepared to interpret the cash position, cash and cash equivalents position in the organization. Similarly, ratio analysis is one of the tool of analysis. It is one of the technique of analysis in which we relate the figures of one statement with another statement. We find out some ratios and then compare these ratios with the industry standards, or we compare these ratios with the ratios of the other counterparts in the same industry, or we compare these ratios with the previous year ratios, so that we can find out whether the company is progressing, or whether the company's funds are managed properly, or whether the company is deteriorating. So this is the thing which we take the help of the ratio analysis to arrive at certain conclusions. So today we'll be continuing with that. So we'll be sharing with you the concept of ratio analysis. So I have moduled this particular segment in two parts. In first part today we will be discussing the concept of ratio analysis, and in the second part we will be consider the practical aspects of the ratio analysis. So today we are going to discuss the first part, that is what is the ratio, why these ratios are calculated, what are the various kinds of ratios. Basically, you have studied all this at the graduation level in the paper of the management accounting. But here, when we are in the post-graduation level, our task is not to find out the ratios only. Our task will be to interpret these ratios and arrive at a logical conclusion regarding a particular company. So that's why it is very important that at post-graduation level, you must have some kind of more inputs in hands, and you can arrive at certain conclusion. So ratio analysis, as I have already told you, is a concept or technique which is as old as accounting concept. So whenever the accounting system starts, people started interpreting. The basic purpose of preparing the accounts was to arrive at certain logical conclusion, so that you can find out what is the progress of the business. If the business is deteriorating, what are the various aspects which are actually affecting the business, so that we can have some kind of diagnosis. For example, go to a particular doctor for curing particular disease, you find that he examine your body properly. So similarly, when an investor want to invest in the business or a stakeholder want to take a decision regarding some relationship with the business, maybe as a debtor, maybe as a creditor, maybe as a service provider, or maybe as a person to interact with the business, to do some business with your concern, they want to have a complete diagnosis of your business. And the ratio analysis is basically one of the method to diagnose the business, one of the method to diagnose the business abilities, one of the method to diagnose the some weaknesses in the business, so that a logical decision can be taken by the person who is going to interact with your business after taking the analysis of your financial statement. So ratio analysis we are using from the century. So it is as old as the accounting concept. So basic objective of accounting is to report the about the business, about its financial position, about its income position, or about the various aspects relating to the stakeholders, on the basis of which we can take a decision. So therefore, it is as old as the accounting concept. So as far as ratio analysis is concerned and other quantitative techniques are concerned, basically they help us to assess the risk involved in the business. Because everybody who is dealing with the business or is going to have some kind of interactions with the business, they want to first take the assessment of the risk. Suppose as a creditor, suppose I am a bank and I'm going to give the loan to the any concern, any company. First of all, I will diagnose whether my loan will be returned back or my interest payments, which will be due on the loan which I am going to provide, will be given to me. This is, and I want to have the risk perception about it, whether the company's cash liquidity position will be sound, whether the company's solvency position will be sound, whether the company's profitability position will be sound. So I want to have assessment of risk about that business from various angles. So ratio analysis and the other quantitative techniques, because ratio analysis is now a traditional technique, and now there are a number of other techniques which has come into picture. So as and when you will progress in various semester, you will find these techniques also, because in operation research also we have very important techniques. For example, linear programming is there. So the technical analysis is done on the basis of these techniques, and ratio analysis also helps into that. For example, we have a technique of data analysis, envelopment analysis, which is known as DEA. And ratio analysis, the ratios which are calculated in the ratio analysis helps in doing the data envelopment analysis. So this is a technique which helps in the assessment of risk regarding the business. So if I want to just discuss in brief about the conceptual meaning of the ratio. So ratio is basically, ratio analysis means the process of computing, determining and presenting the relationship of the related items and groups of items of the financial statement. So when we place the one figure of the financial statement in relation to the other in quantitative terms, for example, we relate the net profit as compared to the sales, or net profit as compared to the investment made by the outside or investment made by the equity shareholders. That is a relationship of related items and group of items of the financial statement, so that we can compute, determine and present the relationship for analysis purpose. So this ratio analysis provide in a summarized and concise form of a fairly good idea about the financial position of the unit, and they are the important tool of the financial analysis. So in the figures which are provided in the financial statements, single figures, for example, you have a figure of net profit, you have a figure of the investment, you have the figure of gross profit. If we will consider them individually and in isolation or in comparison with the others, you will not find any result. So they are the ratio analysis is very, very important tool for financial analysis. So we should keep in mind. Now the question before us is, why ratio analysis? Why we compute the ratio? What is the need that we are relating the one figure of the financial statement of one financial statement with another financial statement, what is the need of doing this exercise? Whether it's a wastage of time? No, because anybody who is interacting with the business, may be owner, maybe creditors, maybe debtors, maybe financial institution, maybe government, or maybe prospective investor, they want to have the appraisal of your company before interacting with you. For example, a supplier who is providing you the goods on credit or give you some time to repay their amount uh, for which the goods has been provided. Similarly, a financial institution who is providing the loan want to have various kinds of analysis. For example, if a loan is provided by the bank for 20 years, the installment of which will be paid in the 20 years, the bank would like to have technical appraisal, they would like to have commercial appraisal, similarly they would like to have financial appraisal, economic appraisal, and management appraisal. So various stakeholders want to have different kind of appraisals of your company. Technical appraisal, that means what is the input output relationship. Commercial appraisal, whether you are providing good profits, whether your assets are justifiably used. Financial appraisal, whether your liquidity position or solvency position is very sound. You would like to have economic appraisal because we want to know whether your unit or your company is economically viable. Or management appraisal, that means to judge the efficiency of the managerial persons who are involved in the affairs of the management of the company, to know their technical as well as commercial or financial or economic viability or economic efficiency we would like to test. So ratio analysis is providing help in all these kind of segments, that is technical appraisal, commercial appraisal, financial appraisal, economic appraisal, and management appraisal. So that's why though there are a number of weaknesses in the ratio analysis, but now with the passage of time, new improvements are made in the ratio analysis. Or the ratios which are calculated for different years are now used for further technical analysis by the techniques of the operation research or other statistical techniques, so that we can arrive at a logical conclusion after technical, commercial, financial, economic, and management appraisal. So ratio analysis helps into that. Now, what is the ratio analysis? It's a tool basically which enables the banker or lender to arrive at the following factors. Suppose I want to know the liquidity position of the company. In one financial statement, it will not be looking very sound, but we have to compare it with other figures. We want to know the profitability of the company. We want to be sure about the solvency of the company. We want to be sure about the financial stability of the company or quality of the management. And we want to be sure about the safety and security of the loans and advances to be or already provided to the company. So ratio analysis will help us to analyze these all positions, maybe liquidity, maybe profitability, maybe solvency, maybe financial stability, quality of management, safety and security of the loans and advances. So ratio analysis is basically will be helping into that. So, but as I already told you that ratios are basically when we place one figure of financial statement in relation to the other. So it is a basically quantitative relations between the various figures of the financial statement. Maybe one figure we may take from profit and loss account, one from the balance sheet. It may be a composite ratio that you may have one or two or more figures in hand, and on the basis of that you arrive at certain logical conclusion. But before looking at the ratios, there are a number of cautionary points concerning their use that need to be identified. So sometimes the owners or the managers of the company, they want to project the very good portrait of their organization by using or misusing the ratio analysis. So we must be very cautious about the use of the ratio analysis. First, when we are computing ratios, the dates and duration of the financial statements being compared should be the same. If not, effects the seasonality may cause erroneous conclusions to be drawn. So dates and duration of the financial statement being compared should be the same. So if you are comparing the ratios of one company with another company, so their financial statement should be having same dates and same duration. Number two, the accounts to be compared should have been prepared on the same basis. As we have talked earlier also, that basically the standards which are prepared, that is to bring the harmonization and in accounting practice. If accounts are prepared on different basis, then they will not be comparable, and the different treatment of stocks or depreciation or assets valuation will distort the results. For example, if one company is using that method of depreciation, straight line method, another companies use written down value method, so their figures will not be comparable on this aspect. So in order to judge the overall performance of the firm, we should not take one ratio, we must find out the group of ratios as opposed to just one or two should be used. So in order to identify trends, at least 3 years of ratios are normally required. So one ratio do not give any portrayal of about the company. So we must take group of ratios, and we must take compare the 1 year ratios, at least 3 year ratios, so that we can arrive at logical conclusion. So as far as the utility of the ratio analysis is concerned, it will get further enhanced if the following comparison is made. Number one, uh, between the borrower and the competitors. So between the borrower and the best enterprise in the industry, between the borrower and the average performance of the industries, between the borrower and global average. So we will find out suppose I am taking a loan from financial institution, bank will compare my ratios with my competitors ratio. Similarly, they will compare the ratios of my company with the best enterprise in the industry. They will compare my company's results with the average performance in the industry. So they will also compare the my results with the global average. So that the advantage or the utility of the ratio is enhanced. So now question arises, how the ratios are expressed. It may be expressed as a percentage, it may be expressed as a proportion, or it may be expressed as a pure or number of items. For example, as a percentage, such as 25% or 50%. For example, if net profit is 25,000 and the sale is 1 lakh, then the net profit can be said to be 25% of the sale. So here we have related two figures. We have created a relationship between two figures. On the one hand, we have net profits. On the other hand, we have sales, and express profit as a percentage of sales. So number one, ratios can be expressed as a percentage. Second, ratios can be expressed as a proportion. For example, the figures may be expressed in terms of relationship between net profit to sales. So to write 25% in another way, we can say 1:4. It means 1/4 profit is earned from the total sale. So 1:4, that means number of, as a proportion we have expressed this. Similarly, as a pure number or time, we can write 25% as a 1/4 also, 1:4 also, or 25% also. As a pure names, this ratio same can be expressed in alternatively, such as the sale is 4 times the net profit, or profit is 1/4 of the sale. So it may be expressed as a percentage, it may be expressed as a proportion, or it may be expressed as a pure number time. So these are the various ways to express the ratio. So according to the situation, or according to the requirements of the analysis, we can express them as percentage, as a proportion, or as a pure number time. So these are the ways in which the ratios can be expressed. Now quickly we'll be looking at the various classification of the ratios. There are a number of bases of classification are there in the ratio analysis. Some are called balance sheet ratio. If all the figures relating to balance sheet are taken, no figure from the income statement, we can say that this is a balance sheet ratio, because we have used only the figures from the balance sheet. Similarly, if you have taken only the figures from the profit and loss account, or income statement, or revenue statement, then we will say these are the profit and loss account ratio. So income statement ratio, revenue statement ratio. But if you have taken one figure from the balance sheet and another figure from the profit and loss account, we would like to say that this is a composite ratio to arrive at the logical conclusion. So first we will be talking about Some of the examples are financial ratio. For example, current assets, current ratio. In current ratio, we have current assets and current liabilities, both are lying in the balance sheet. Quick asset ratio, we have quick assets and current liabilities, both are lying in the ratio. So proprietary ratio, how much percentage of total assets is owned by the proprietor? So both the figures are lying in the balance sheet. Debt equity ratio, so both the figures of debt and equity are lying in the balance sheet. So therefore, these are called balance sheet ratio. Similarly, we have profit and loss account ratio or trading profit and loss account ratio. So here the figures only from income statement is taken. For example, gross profit ratio is there. Two figures, gross profit and sales, both are taken from the trading profit and loss account. Similarly, operating ratio, operating expenses, net sales, expense ratio, expenses divided by net sales, net profit ratio, net profit divided by net sales, stock turnover ratio, cost of goods sold in relation to net sales. So both are taken from the trading profit and loss account ratio. So these are also called income statement ratio. For example, thirdly, we have fixed assets turnover ratio. This is a composite. On the one hand, we have taken fixed assets. On the other hand, they are related to sales. We want to have the efficiency of the fixed asset turnover ratio. Similarly, return on total resources. How much return you have earned on the total assets of the concern, how much return you have earned on the proprietor's fund, that is own fund, what is the earning per share in relation to the profit. Similarly, the debtors turnover ratio, stock turnover ratio, debtors turnover period. So all these are composite ratios which are calculated on the basis of various classifications. So when you read your books, number of other classifications may be available in you, but broadly we classify the ratios into three segments: balance sheet ratio, profit and loss account ratio, or composite ratio. So this is the format of the balance sheet we will be using for ratio analysis. You have asset side, you have liability side. On the asset side, you have fixed asset, non-current asset, current assets, intangible assets. On the liability side, you have net worth, equity, owned fund, that is share capital, reserves and surpluses, credit balance of profit and loss account. So all these are figures are given. Similarly, you have long-term liabilities and borrowed funds, current liabilities, they are mentioned here. So this format of balance sheet will be used particularly to calculate the various kind of ratios. But some important notes we must consider while preparing the ratios. Number one, liabilities has credit balance and assets has debit balance. You know all this. Current liabilities are those which are either become due for payment or shall fall due payments within 12 months from the date of balance sheet. Similarly, current assets are those which can be converted into cash or undergo change in their shape from within 12 months. So they are also called working capital or gross working capital. Net worth and long-term liabilities are called long-term sources of funds. Current liabilities are known as short-term sources of funds. So similarly, long-term liabilities and short-term liabilities are also called outside liabilities. So current assets are short-term use of the fund. So while interpreting and calculating, now let's come to some assets other than current assets are long-term funds. Installment of term loan payable in 12 months are to be taken as current liability only for the calculation of current ratio and quick ratio. If there is a profit, it shall become part of the net worth under the head reserves. If there is a loss, that will become the part of the intangible assets. So similarly, investment in government securities are to be treated as current assets only if these are marketable and due. Investment in other securities are to be treated as current if they are quoted. Investments in allied, associate, sister units or firm to be treated as non-current assets. So bonus shares are to be issued by capitalization of the general reserve and as such do not affect the net worth. With right issue, changes take place in the net worth and current ratios. These are the certain important point. Now let's come to the ratios which are calculated. First, we'll be talking about the liquidity ratios. So liquidity ratios can be of basically three types. Number one is current ratio. Now, current ratio is also called working capital ratio. It is the relationship between the current assets and current liabilities of the concern. So here we will not make distinguish between the quality of the current assets or the quality of the current liabilities. In straight way, we'll take the total current assets and total current liability. So formula for this will be current ratio is equal to current assets divided by the current liabilities. So here this will be the method. For example, if the current assets and current liabilities of the concern and 4 lakh and 2 lakh respectively, then the current ratio will be 4 lakh divided by 2 lakh, that is 2 is to 1. So now this ratio has a one standard also. So standard means industry standard is 2 is to 1. If the ratio is 2 is to 1, it means it meets the requirements of the industry. Higher this ratio, the better it is. But too high current ratio will reflect the inefficiency in managing the current assets and current liabilities of the concern. So that may be a matter concern. So 2 is to 1 is a standard ratio as compared to the industry. Then sometimes we use the term net working capital. That means current assets minus current liabilities. This is in relation to this ratio. So current ratio will be calculated by current assets over current liabilities. So net working capital, if you want to find out, that is current assets minus current liabilities. So if concept of net working capital is required anyway. So as far as because we are using the term current assets over current liability, what do you mean by the current assets? So current assets usually means raw material, stores, spares, work in progress, finished goods, debtors, bills receivable, cash, and prepaid expenses. So all these are treated to be current assets. So as far as the current liability is concerned, sundry creditors, installment of term loan, so all kind of short term payable within 1 year and other liabilities payable within 1 year. So all this is required to calculate the current liability. So current ratio is concerned, it measures the short term liquidity of the concern and ability of the firm to meet its short term obligations within 1 year of the period. So it shows the liquidity position of the enterprise and its ability to meet current obligations in time. Higher this ratio, the better it is from the point of view of creditors. In the long run, very high current ratio, as I have already told you, may affect the profitability because high inventory carrying cost may be there. So your debtors may not be serviceable. So it shows that a liquidity at a point of time, the position can change immediately after the date. So trend of the current ratio over the years to be analyzed. So it is not there you compare the 1 year figure only, you have to compare the figure from different years also so that we can arrive at a logical conclusions. So these things you should keep in mind while calculating the current ratios as far as is concerned. So similarly, now let's move to another kind of ratio, which is acid test ratio, because the current ratio has certain kind of issues, certain kind of problems, because current ratio may not reflect the efficiency of the, so for that purpose we calculate the sometimes we calculate the liquid ratio. Liquid ratio mean liquid asset, that is cash plus bank balances, receivable, bill receivable, realizable securities, but we don't take into account the inventory. But for acid test or quick ratio, it is the ratio between current assets and quick current assets and current liabilities, and that should be equal to 1. So quick current assets are cash and bank balances, bill receivables, quickly realizable securities or quickly marketable securities, or bank fixed deposits which are realizable in a very short period of time. So quick assets or current liabilities will be the formula for this. So usually we take 1 is to 1 as the standard of industry. So higher this ratio, better it is, but too high ratio will reflect that your cash remains idle, your debtors, they are realized, but the securities and all the other things which are related in the current assets, quick current assets, are not utilized properly. So example here is this. For example, you have cash 50,000, debtors is 1 lakh, inventory is 1 lakh 50,000, current liability is 1 lakh. So total current assets here will be cash plus debtors plus inventories, that is 3 lakh, and current liability is 1 lakh. So current ratio here will be 3 lakh divided by 1, that is 3 is to 1, and the quick ratio will be 1 lakh 50,000, because we will take only cash plus debtors, not inventories. It is said that inventories cannot be realized into cash without the loss of value. So that's why we'll take only 1 lakh 50,000 divided by 1 lakh, that is 1.5 is to 1. So this is the some improvement in the current ratio to analyze the liquidity position of the firm in a more better way. Similarly, this was current ratio and quick ratio was the short term liquidity position. So now we have to find out the long-term solvency position of the concern. For that purpose, we calculate the debt equity ratio. So basically, debt equity ratio, it is the relationship between borrower funds and the owner's capital. So that's why we calculate the debt equity ratio. So long-term outside liabilities divided by tangible net worth. This is the formula for calculating the debt equity ratio. So liabilities of the long term nature and total of capital and reserves and surpluses less intangible assets is the formula for arriving at the net tangible net worth. So therefore this formula is helping us to arrive at the logical conclusion regarding the long term solvency of the concern. Let's take an example. If the firm is having capital of rupees 200 lakhs, free reserves and surpluses 300 lakhs, and long-term loans and liabilities as the 800 lakhs. So we can arrive at that long-term liabilities here is 800 and our capital plus reserve is 500. That is 1.5, 1.6 is to 1 is the ratio which is arrived at. So usually it provides the reflection about that debt which are used and owner's equity. It is the relationship between the owned funds and loaned funds. Loaned mean outside funds and owner's equity, that is mean owned funds. So this is the relationship of debt and equity in this manner. Similarly, you have find out the proprietary ratio. That means tangible net worth over total tangible assets. So this ratio indicates the extent to which tangible assets are financed by the owner's fund. So here we will find out tangible net worth, that means share capital plus reserves minus any kind of fictitious asset and divided by the total tangible assets. So it means all intangible assets will be excluded from that and will be multiplied by 100. So this ratio will be 100% when there is no borrowing for purchasing of the assets. So but it is not there, we always borrow funds or money from the outside also. So therefore this ratio reflects the proportion of the owner's funds in the total tangible assets which we are using it. So I think because the timing is running short, so we will continue in the next part other ratios as well as its practical aspects as far as it is concerned. So I stop here because other class is also joining and we have to start at 9:40. Now you can on your videos for a 2 or 3 minutes discussion for on this topic. On your videos. So I will be sending you the full presentation on the Google Classroom. So if you want to have more detailed investigation, you can use your books, which were you was using in the final year, become final year in the paper of management accounting, wherever you have studied. So that will help you to arrive at more logical conclusions. So because we have to move very hybrid, so the universities are planning that like Institute of Chartered Accountants of India has conducted the examination offline. So they may conduct your examination offline in the month of January end or in the February first week. So therefore, we have to adopt the hybrid teaching and you have to work hard for that. So it is advisable to you to really cope up with the structure of education which is provided to you so that at the end you cannot face any, you should not face any kind of difficulty. So anything you want to say or ask, you are welcome for 2 minutes. The floor is yours. 2 minutes you have. No question? Yes, Shweta, you want to say something or ask anything?
No, sir, it's clear.
It's clear. Chalo. Okay. So I will be sending you the presentation which I am using here to explain you the various concepts. Go through that so that tomorrow when you come for the lecture, you are absolutely clear about it. So, for the time being, thank you very much to all of you. So in MCOM first year, May